Mark Paller here for Paller Financial. We are a CPA and financial planning firm offering advisory services, investment management, and income tax preparation. Today I'm going to introduce the 2017 Tax Cuts and Jobs Act. By no means am I trying to turn you into a tax expert, but rather toss a stone across the pond to taxation and give you an idea of some of the things you may want to keep an eye out for. The law was signed on December 22, 2017 by President Trump. It's 479 pages long and increases our deficit over the next 10 years by less than $1.5 trillion. That was important because it enabled it to pass with a simple majority of Republican votes. This is the biggest change in tax law in the past 30 years. This is a sample of the first 2 pages of the individual tax return. I'll take it section by section and illustrate some of the changes you may want to keep in mind. 2 items to discuss here: moving expenses and alimony. With the swipe of a pen and a little magic, moving expenses will no longer be deductible. Historically, if you're moving because you had a job in another location, you're able to deduct those costs. Or if the company paid for the move, they could deduct them. But now, if the company reimburses you, it's just W-2 compensation. Starting in January 2019, alimony will no longer be income to the recipient nor deductible to the payer. Because of this change, payers will have more income to report and probably pay more tax. As a result, I'll bet that this will substantially change how property settlements are negotiated in the future. Making America great again was a top priority for our president. To make our corporations more competitive, the law reduced the regular corporate rate to 21%, from a top historical rate of 35%. In fact, over the last couple weeks, some companies have mentioned that they may be increasing compensation and benefits to their employees and attributed these changes to the income tax rate reduction. To try to equalize the 21% rate for big corporations with those on pass-through entities, which includes sole proprietorships, partnerships, S corporations, LLCs, and some farms. They created a new calculation to enable us to take a deduction of 20% of our profits before we calculate our personal income tax. Now, there are a tremendous number of rules and exceptions to this deduction. If this applies to you, please make sure you check the calculations carefully. Some other fun business facts. As of January 2018, entertainment expenses will no longer be deductible. The business can still pay the bill, but they will not show as an expense when you do your return. Meals are still 50% deductible, except for those that are for the convenience of the employer, which are 100% deductible. As of the date that the law was signed, sexual harassment lawsuits that have non-disclosure agreements are not deductible. However, should you be willing to disclose the situation, then you can still deduct the costs. It's my guess that this was part of the Me Too movement and was slipped in right at the last moment. For all practical purposes, equipment purchases up to $1 million may be either written off using bonus depreciation or Section 179 of the tax code. Moving to the second page, the standard deduction and exemptions have been compressed into a new larger standard deduction of $24,000 for married taxpayers filing a joint return. This compares to a previous amount of $21,300 for a household of 2. As we go forward, please remember the $24,000 number, as it is the first hurdle to determine if it is worthwhile to itemize. Now let's drill down into the itemized deductions. But before we get started, remember that different states may or may not follow the federal adjustments. For federal purposes, in order for it to be beneficial to itemize, the amounts need to add up to more than the $24,000 previously discussed. For 2017 and 2018, medical deductions need to be greater than 7.5% of adjusted gross income. This is the number at the bottom of page 1 of the tax return. Starting in 2018, the maximum amount that may be deducted for SALT taxes, that's state and local income taxes, is $10,000. Mortgage interest will only be deductible for mortgages less than $750,000 for the purchase and/or construction of your home. Should you take a loan against your home for business purposes, then an Election 10T needs to be filed so that the interest paid on that loan can be deducted against the business. No other miscellaneous itemized deductions are allowed. These were things like tax preparation fees, investment fees, safe deposit boxes, and employee business expenses. After applying these limitations, should the total of the itemized deductions be greater than $24,000, then it will be worthwhile for you to itemize. Otherwise, it will be in your best interest to accept the standard deduction. Remember, we no longer get exemptions. This was where each of us got about $4,000 per person as a reduction to our income before we calculated our tax. Senator Rubio recognized that this could be a problem for families with children, so he held out and negotiated an increase in the child tax credit. Should you have a qualified child who is your dependent under age 17, you'll be eligible to take a $2,000 child tax credit. This credit phases out for married households with income in excess of $400,000. This is the tax schedule under the old law versus the new law. Notice there is no change at the 10% bracket. The 15% bracket has been reduced to 12%. In other words, 20%. Should a married household that files a joint return have income at the top of the new 12% bracket and use the standard deduction, then they would save approximately $2,322 in taxes. Under the same scenario at the top of the 22% bracket, that family would save $2,145 in taxes. I was interested in finding out who this would affect. Based upon the 2013 data from the Tax Foundation, approximately 77% of taxpayers were in the 15% bracket at that time. In other words, a good portion of our citizens will see about another $200 a month in spending money. I doubt these resources will find their way into additional retirement plan contributions. It's my guess that this will be used to help with health care costs and other discretionary purchases. In any event, all these small purchases could add up and greatly impact our economy. Oh my goodness gracious, healthcare. For 2017 and 2018, nothing changes. But in 2019, the line on page 2 of the tax return for the penalty will go away. Now recognize that the Affordable Care Act, commonly known as Obamacare, is a different law than the tax law. The Tax Cuts and Jobs Act removes the penalty from the tax return, but it doesn't change the Affordable Care Act. So Lord only knows what's going to happen over the next 2 years. But what we do know that things will change. As we jump into 2018 and beyond, appreciate that this was the biggest change in the tax law over the last 30 years. Be aware, double-check the law and your calculations. At Paller Financial, we're looking forward to your success, and please call if we may be of service.